Okay, great. I think it's 4, so let's start. Before I get started with today's presentation, a couple of procedural things. So uh, I'm going to take a break from the advanced series videos. So we finished our stock zero to hero session and we'll start a new topic, but I want to take uh, uh, the next 2 weeks to really focus on researching for our small case and writing research papers for our members. So we will continue our advanced sessions thereafter, after a 2-week break. And then we'll kick off with a new topic. But in the interim, you'll see lots of research papers and thoughts flow through, as well as some changes in our small case, etc. So we think it's a good investment of time to do that. The beginner sessions will continue on a 2-weekly cadence. So let's get started with this one. So this is part 4 of the personal finance from mystery to mastery. And just to do a quick recap of what we did last session. So we covered what the second pillar is all about. Again, it's about you've done the hard work of saving. Now you got to reap the benefits of that saving. And that's where investing comes in, the second pillar. How do you deploy those savings in a manner most effective to building your wealth over a long period of time? That's what investment is all about and what we're trying to answer here. We also learned why investing is a must. We learned that investing always comes with risk. And if it comes with risk, why can't we just take our savings and put them under the mattress or in a very low interest account? And the reason that we learned was that inflation is the tendency of prices to increase over time, eats away the value of your savings in real terms. So if I just took my money and I put it under a mattress, I'd wake up, 10 years later and I'd find that I can buy a lot less with that money than 10 years previous. So we need to invest that money to preserve our purchasing power of our savings. So we've learned that investing is not an option. It has to be done. So the good news is we'll teach you how to do it, and we'll teach you how to do it in a very effective way. We also understood what the principle of risk and reward matching, that in general in investing, there's no free lunch. And if something looks too good to be true, it probably is. Um, and in this course, we're not going to focus on trying to find bargains that have very high rewards and lower risk. Although that's possible, it requires lots and lots of work. And that's more something that we cover in our advanced sessions. We also talked about financial compounding and the power of it. We learned how just a little bit of growth every year adds up to a lot of wealth down the line. So that's very encouraging. And it says that time's on our side in terms of building our wealth over time. And now in this session, what we're going to do is deepen our understanding of savings and their function. And we're going to use that to understand how to best invest. If we understand what our savings are supposed to do, we can find and design our investment strategy around those functions. So that's kind of the framework we're going to use here. And we're going to understand why this is really the key to investing. And it's a step that most people skip. And it causes a lot of danger if you skip this step. So we highly recommend that all our members use this framework when they think about their own portfolios. And then I'm going to show you a framework that you can use to evaluate any investment opportunity that comes your way. Because here at Bharosa Club, we don't know all the investment options that you guys face. There are lots of small little schemes and opportunities that are out there for you. But rather than us telling you whether they're good or bad, we're going to give you a framework so that you can use that framework to apply to that investment to see if it fits your needs. And that's going to be much more powerful than someone telling you whether this makes sense for you or not. And then we're going to conclude this session with understanding the difference between debt and equity. And then we'll cover what we're going to cover in the next session. So a lot to do this time, and it'll be a pretty informative class. So let's understand our savings more deeply. Why do we save, and what are these savings supposed to do? So the first thing to observe is that savings are not created equal, that our savings provide us with 3 distinct functions that we're going to cover. And understanding this helps you allocate your savings appropriately. So what are the three functions? So at the bottom, let's start at the bottom where it says my rainy day fund. So this element of your savings, its role is to protect you from unforeseen circumstances and hardships. So that could be a job loss, it could be a medical emergency, it could be a loss of assets, someone steals your uh, uh, car or something like that, right? Where you have a loss that you didn't expect. We all have to protect ourselves against these losses in our lives. So, so one function of our savings is to provide us a rainy day fund that we can use should something go wrong in our lives. Um, so that's one function that our savings play. The second is our savings, as we learned, can also provide a replacement for our income. So this gets very important the closer and closer we get to retirement, where our investments need to cover the income that we're losing from our salary. So that's another function that savings play. And the third function is your growth bucket, right? This is the portion of your savings that you are using to grow the amount of your assets over time so that one day you will have enough savings to replace your salary and retire and become financially independent, right? So when we understand these three functions of our savings, we can better understand how big we need each of these buckets to be for our own personal circumstances. And that'll help guide what kind of investments we should be looking for. So that's exactly the first step that we recommend. And the key to investing successfully for our members is basically answering these questions. One, understanding how large your bucket needs to be. What are your fixed expenses? How old are you? What are your life goals? These are some of the questions that will help you determine how big your bucket should be. The second is then finding investments that are well suited to each of your savings buckets, right? And the third is adjusting as your life changes. As we age, as you take on more responsibilities in life, or as you get closer to retiring, your buckets will also change. If I have a child, then I need to be a little more cautious because I'm going to have a lot more expenses coming in. So maybe I need to change my buckets. If I'm going to retire, then I need to change my buckets to replace my income that I'm losing. So these buckets are not static and fixed, and every year or so you should take a fresh look at your buckets, make sure your assets are in the appropriate category of savings that work for your life stage and your circumstances. So now let's talk about how we determine the characteristics of an investment and whether they're well suited for a particular bucket or not. So we covered a little bit of this terminology last time, but let's just go through it again. So the amount I invest into my investment is called the principal or capital that I put in. And this is how much I'm risking in the investment, right? The amount I get back is the total return, the IRR of the investment. We learned that IRR is just basically the average annual return of an investment. And that's how people commonly compare different classes of investments. But this basically tells me my reward for parking that money in an investment. And generally, the money I get back from an investment relates to two things. One is how much does that investment pay me every year? So you can think of this as current income. If you buy a bond or you loan money to someone, this is the interest payment that comes back to you every year. Or if you buy a stock, this is your dividend payment that you get every quarter or year. And so we call this current income. It's actual income you're getting every year. The other component that determines how much we get back is the appreciation you see in your investment. So this is, for example, you may have bought Reliance stock at 500 rupees a share. Then the stock price went up to 1,000 rupees a share. So you made double because you sold it at twice what you bought, right? So essentially, that's another factor that comes into our return, and that's called appreciation. And certain characteristics of investments may have more prospects of appreciation, but less aspects of current income generation. So we want to also think about those things when we look at the characteristics of an investment. The next is how long you invest for. So this is the investment horizon, tenor, or holding period of the investment. And sometimes you'll have to park your money for a long time. If you buy a long dated bond or you lend money for a long time, it's a long commitment that you're taking on the investment. Or if it's a short commitment, then it'll be a shorter time period. And then what you invest in, equity or debt. And now that'll we'll cover at the end of the class, but that'll determine how much risk you're taking in terms of the order of where you sit in the repayment of the investment. We'll discuss that at the end. But these are some of the parameters that we're going to think about as we think about what bucket these investments fit into. So let's spend a little bit more time in understanding the risk that we're taking when we invest. So what are all these risks that we keep thinking about when we invest? Well, there are three kinds of risk. So the first is capital or credit risk. And this basically, in very simple terms, means what is the risk if I give you money or I park my money in an investment that you don't pay me back the full amount, or I'm not able to sell the investment for the amount I put in it. So the price falls, or the borrower never repays me money, runs away, defaults, or the company runs into trouble and cannot pay back the full loan. So this is what we call capital or credit risk. It essentially measures the likelihood that a company or person runs into trouble and is unable to make good on the investment. The next category of risk, so that's a pretty straightforward category of risk, right? That just means that something went wrong with the business. The next category of risk is called liquidity risk. So we talked about how different investments have different investment horizons. And liquidity risk measures the risk of us needing the money sooner and not being able to get out of the investment. So let's say I buy a 10-year bond. I lend money for 10 years to a company, right? And something goes wrong in my life and I need that money back sooner. Now, I've lent that money for 10 years. So I can either wait 10 years and get it paid back, or I need to sell that bond, that loan, to somebody else that's going to buy it from me. But I don't know what price he's going to pay me for that. So I may have to take a loss to get out of that loan early. And so that you can think of this liquidity risk as the risk of breaking your FD early if you need the money, or, that's a very simple example. And sometimes this liquidity risk can be quite acute. And we see this with Franklin Templeton, right? So people that invested in Franklin Templeton funds, they ran into liquidity issues because the fund was forced to close, meaning you can't sell that fund now, right? So liquidity can turn out to be a significant issue sometimes. So it's something worth paying attention to as you think about your own investments. The last risk that we need to think about is something called interest rate risk. So here again, let's pretend that I loaned money for 10 years. And I loaned it at a fixed rate that looked pretty good. I loaned it at 9% interest rate, okay? But let's say that 5 years down the line, interest rates have gone up and I could have lent that money now today at a 15% interest rate, right? So basically, the longer you commit to a particular interest rate, the more risk you're taking that you're going to miss out on opportunities that occur if interest rates move higher than what you agreed to lend your money at. So that's the other thing that we need to think about as investors. Another way to think about this is, let's say that I agreed to give you money at 7% per annum. You wanted to borrow some money from me. And when I agreed to lend you this money, inflation, the rate that prices were increasing was only 5% a year. But then they climbed to 10% a year. Now I'm only charging you 7% a year on your loan, but inflation is now growing at 10%. So you are actually going to pay me back less money than I'm losing on inflation. So this is why we really need to think about interest rate risk also. So those are the three kind of risks that you have to worry about when you're investing. And you should keep these risks in mind every time you're evaluating an investment. So now let's think about how the parameters of risk relate to our savings bucket. Okay. So what we're going to do here is just look at these buckets. So let's start with the rainy day fund. So my rainy day fund. What is the rainy day fund supposed to be for, right? It's supposed to be for unanticipated events that occur in my life. So I can't predict these. I don't know when I'll lose a job. I don't know when I'll have a medical emergency. I don't know when I'll get into an auto accident or whatever, right? So these funds need to be liquid, meaning I can sell and get out of them very easily. If, for example, I had put my rainy day money into Franklin Templeton, right, it would be very hard for me to get that money out. So this is why liquidity risk has to be low for your rainy day fund. You should not be putting this money into things where you're locking up your money for a long time, because you don't know when you're going to need to break that lockup. Or you should understand very well what the penalties are for breaking your money. So for example, if you have an FD and you're putting your rainy day fund into your FD, you need to know what the breakage fee is to break that FD if you need to, right? The other thing that we can think about for the rainy day fund is we need to make sure this money is available to us, right? So you don't want to take too much risk in terms of capital and credit risk on your rainy day fund. You can't be lending this money to risky people or companies where you may not get this money back. So we know that capital and credit risk also has to be very low for our rainy day money. And therefore, we're willing to take a lower return on this money. We care much more that this money is liquid and that it's not invested in risky assets. So I'm okay getting a lower rate in return for safety. So this bucket is going to be our safe bucket, our safest bucket of investments. Now let's think about these two buckets. So we have our income sources. So again, income sources are meant to replace your salary, right? So they're supposed to give you income that you can use to fund your lifestyle. So in this case, we're looking for investments where the return comes from current income, right? Remember, there were two components of return: appreciation, which is how fast the price increases, and current income, which is how much money I'm getting every year from this investment in the form of a dividend. So for these buckets of investments, we care much more about the current income and less about the appreciation of that asset. The other thing we care a lot about in this bucket is interest rate risk. Why? Because if inflation ends up being stronger than we anticipated, whatever return that we uh, get may not be as good as we thought. It may not cover the deterioration of our savings due to inflation. So it's very important when you're looking at this that you also consider what happens if the interest rates move higher, right? So let's take an example of a fixed versus floating rate loan. If I lend you money and I say that I'm going to lend you the inflation rate plus 3%, right? Then if the inflation rate changes, my interest rate changes. So I'm okay. My investment is fine, right? If the inflation rate goes higher. On the other hand, if I lend you at a fixed rate and I say I'm going to only pay you 7%, you're going to pay me 7%, and inflation moves higher a lot, then suddenly I'm losing real money because the inflation rate is now bigger than my interest rate. So interest rate risk is a very important factor as you think about this second bucket. So now my growth bucket. So with this bucket, appreciation is more important than current income. So this is my bucket where I want to build long-term wealth for myself. So I'm okay parking my money for a really long time in these kind of investments. And I can take more risk in this bucket as a result because I can hold these investments for a very, very long time, right? So it's okay if the stock prices fall. It's okay if we have a crash due to COVID or whatever. I can just hold my money. And this is kind of why we say that when you're investing in stocks, it's very important that you have a very long holding period for your stocks. So at Bharosa Club, we don't recommend that people invest money in the stock market that they can't hold for 10 years, right? So, and this is why, because you can then hold your investments when markets turn against you and you don't need that money sooner rather than later. And while it's okay to take more risk in this bucket, we still recommend that you be very careful about capital risk. Now, remember, capital risk is putting money in things that don't end up doing well. So, for example, a deadbeat who won't pay your loan back, or a company that runs into trouble and goes bankrupt. If you take capital risk, it's very hard to get that money back if the company fails. So you still want to try and avoid those, but you can look at taking more risk in this bucket than the other buckets. So I just want to, Anita, will you just mute everyone? I think now what I want to cover is a case study of what not to do and how not paying attention to these buckets can really hurt you if you're not careful. So we're just going to walk through a case study of a hypothetical investor and see what can go wrong if you don't pay attention to the buckets. So in this case study, we're talking about a hypothetical person. Rahul started his first job 5 years ago. He earned 5 lakhs post-tax per year on average for these 5 years, right? And he wondered what to do with his savings and thought he'd invest it all in the stock market because he kept seeing the stocks performing well and said, I want to grow my wealth, so I'm just going to put it in the stock market. Rahul lost his job during COVID and was forced to sell his investments to cover an estimated 5 months of expenses. So now we're going to see the impact on Rahul's decision to put all of his investments in stocks. So here we have Rahul's income and expenses. So as I said, he averages 5 lakhs of earnings over this 5 years post-tax. And I've just assumed 3 in the first year, 4 in the second year, 5, 6, and 7 lakhs. And I've assumed he's doing a decent job saving. So he's saving 30% of his post-tax income. So he's saving this amount here, which I'm just circling with the cursor, each year in fresh savings. And the delta between how much he's taking in and how much he's saving, that's how much he's spending, right? So we can divide that by 12 and we get his expenses per month also, okay? And at the bottom, I've given you the investment return. And this is derived from the Nifty returns over the last 5 years, right? Over this period that I'm assuming for each year, okay? So I'm assuming in the first year, the stock market was -3%, so a little flat. Then it did very well in year 2, very well in year 3, pretty well in year 4. And then year 5 was the COVID year. And I'm saying that he experienced a -20% drawdown on his investments. So if we look at what the effect of this are on his savings, okay? So we have this waterfall here. So he begins his career with 0 in savings. He saves an incremental 90,000 in year 1, and his investment return, because it was a negative year of -3%, so was a little bit negative, and he ended the year with savings net of 88,000 rupees. So in year 2, he began the year with 88,000 rupees. He saved an additional 1.2 lakhs in that year itself. And his investment return on his savings was 26,000. And so he ended the year with 2.35 and so on and so on. So this is going to tell us what his end of period savings was. This line at the bottom is the cumulative savings. That is basically the number, the amount of savings if he didn't invest it. So basically 90,000 plus 1.2 lakhs plus 1.5 lakhs, 1.8 plus 2.1, right? And this is telling us, did his investments help or hurt him? So you can see in the first year, his investments slightly hurt him because the market went down. In the second year, because the market went up, his investments from his end of period savings was much higher than his cumulative savings. So they helped him. That increased and increased when markets were going up, as you'd expect. But then COVID hit, and actually his end of period savings was lower than the cumulative amount he saved, which means that his investments destroyed value and didn't create value for him. So why is this important? Well, it's important because Rahul had no other savings. So he needed money for 5 months of expenses, right? So we know in year 5, his expenses per month are 0.41. So 41,000 rupees per month. And we know he needs 5 months of cushion. So 5 times 41,000 gets us to 2 lakhs. So Rahul needs to sell 2 lakhs of his investments to fund his expenses for 5 months during COVID. And he's going to do it at a loss. He's going to be uh, selling his investments at the worst possible time because he didn't save any money in his rainy day fund to see him through shocks like COVID, right? And this is 28.73% of his investments. So this is what you really want to avoid when you're managing your investments. And this is the problem of investing too aggressively. You always want to make sure that your buckets are appropriate for you and you're protected from risks. You want to, as much as you can, avoid having to sell, being forced to sell at a loss. Because the reality is, if Rahul had waited and was able to wait and didn't sell those investments, then already this minus 20% would now probably be only minus 12% because the market has recovered after the trough levels, right? So this is a case study of how preserving some liquidity for yourself is very, very important to do. So step one, right? So we need to decide our savings bucket. So how do we do this? What are the questions we need to understand? So at Bharosa Club, we recommend that you save a recommended amount of 6 months of your expenses, your monthly expenses. So calculate your monthly expenses, multiply that number by 6, and we recommend you save that amount in a very, very safe fund. So for us, we wrote a paper on this for our members on why our recommendation is this, but we recommend you put it in overnight funds. There are other good options also. FDs are not a bad option, provided that you're very clear on what the breakage fees are if you need to terminate your FDs early, right? So, so the first step is make sure you've allocated enough to this. And that's very simple calculation you can do. If you're above that amount, great. If you're below that amount, we don't recommend that, but you're absolutely fine to be more aggressive, but you need to understand the risks you're taking, right? So for the rest of your savings, right, you need to divide them between these two buckets, my growth bucket and my income sources. And how you decide to divide these are really up to you, right? And what you'll need to factor in, how close are you to the age where you want to retire or become financially independent? If you're close to that age, you want your allocation to the income sources to be higher and the growth bucket to be less, right? Because you don't need a lot of growth. You are more interested in now harvesting the value of your savings. How aggressive you are, how wealthy do you want to become? Do you have aspirations of becoming extremely wealthy? Then you need a very large growth bucket. It's much better to be chasing growth then. How many dependents do you have, etc.? So how much risk is there in your life? If you're supporting a lot of people in your family, then you need to be looking at income sources if you need the supplemental income. So this is a very personal decision, but these are some of the factors you need to come through to decide this for yourself. No one can tell you the right buckets are X, Y, and Z for you. You need to make that decision yourself, basis some of the factors we talked about. The next step, once you've decided those buckets, is now finding investments that are appropriate for your buckets. So I'm just taking you through a framework here, which you can use for any investment. I'm going to use an example of a PPF as a sample to decode, but this shows you how you decode the investment and figure out what bucket it goes into. So let's look at PPF as an example. So how much can I invest in PPF? Well, the minimum is 500 and the maximum is 1.5 lakhs per year. So I'm capped in how much I can put in. Okay. The return. So the return varies. It's a floating rate, right? Which is good. I'm not taking a lot of interest rate risk on that then. And it resets periodically whenever the government changes the rates. And the current rate is 7.1%, right? And it's tax free, right? And how long am I locking in this money? Well, I'm locking it in for 15 years, but there are some abilities to get some partial withdrawals or some loans against the money that I have into my PPF. So there is a big lock-in period of 15 years, but there are ways that I can get some liquidity from the fund if I really need it, right? What about the credit risk? How much credit risk am I taking here? Remember, credit risk is the likelihood that I don't get paid back, right? The risk I don't get paid back is very low because it's backed by the Indian government. So the credit risk is almost zero. The interest rate risk now. So this again is my 7.1% rate going to be good enough in 5-10 years, right? Well, here, luckily, it's a floating rate. So if interest rates move up, then chances are my PPF rate will also move up. So I'm not taking a lot of interest rate risk either. What about liquidity risk? So there is liquidity risk because I have a long lock-in. And like we said, there are ways around the lock-in, but they come with cost. So the loans come with a cost, and there are only partial withdrawal opportunities and penalties, etc., that you have to factor in. So this is not a very liquid investment. So when we look through this framework, it should become pretty clear as we've talked through all these things that this investment is a great option for me to consider for my income source bucket, right? The PPF pays me a good current return, right, of 7.1%, right? It's safe. The credit risk is low. I don't get appreciation, but I get a very strong current income. I the only drawbacks here, and I'm not taking a lot of interest rate risk, which is also good. The only drawbacks here are the liquidity issues, right? And even there are ways for me to get money out if I really, really need to. So this seems like a great opportunity for me for part of my income source bucket, right? And the other thing that we have to take in mind is that there's a maximum of how much can be contributed per year. So this helps us decode where the PPF belongs in my portfolio, and we can now compare it to other investments that we consider for that same bucket and eventually decide on what the absolute best investment is for that bucket of our savings. So this framework can be used for anything, right? You put stocks through this framework, you can essentially use the same framework for stocks. You can use it for bonds. You can use it for anything. And walking through that kind of analytical procedure will help you determine if it's appropriate for your portfolio or not. And then comparing it to other alternatives will let you know if it's the best investment or not for you. Okay, so now before we conclude this class, I just want to talk to you about debt versus equity. So you probably heard these terms before. And they're actually pretty simple to understand. But the differences are very important as we talk about investments further in these classes. So debt basically means pay me back with interest. I'm giving you a loan and you have to pay me back that loan with interest. But I'm just lending you money and I'm not becoming a partner with you or anything. In equity, I'm becoming a partner with you. I'm actually buying a little piece of your business. And so I become a co-owner. Okay. So that's basically the two different ways you can invest into a company. So what are some examples of these, right? So debt. So savings accounts. When you put money into a bank, you're essentially lending that money to the bank, and the bank is agreeing to pay you back that amount of money whenever you withdraw your money from the savings account. So you're demanding to repay your loan be repaid when you withdraw your money. So this is a debt investment that you're making into the bank, and you get your interest rate as your fee. A fixed deposit, very similar to a savings account, except you're agreeing to lend your money for a fixed amount of time, right? So that also is a debt investment. Then loans, bonds, commercial paper, money market, these are all other forms of debt investments, right? Then you have your equity investments. So equity investments, again, I'm becoming a co-owner of something. So I'm buying a piece of something, right? I'm owning it. So stocks and shares, when I buy a share or a stock, I'm buying an ownership interest in that share or stock. I'm never going to get repaid on that from the company. I can sell my stock, right? But it's not a repayment. It's selling that interest in the company, just like anyone can sell a house, right? And then real estate. When I buy a home, I'm owning that house, right? So again, I'm taking ownership. So that's equity. So now I've just put a little note down here. A mutual fund, right, is just a type of a debt or equity vehicle. So a mutual fund can be both debt or equity or a hybrid, potentially both. And it really depends on what the mutual fund's invested in. We'll talk about mutual funds later in the next class. Okay, so equity and debt have very different characteristics. So if I lend via debt, I'm lending money to a company that has to pay me back. So if the company does well or does badly, I really don't care in terms of how much you owe me. If you do well, fantastic for you, but you still owe me the same amount back, right? If you do badly, I'm sorry for you, but you still owe me what I lent you. So what's the risk I'm taking in debt? The risk I'm taking is that you can't pay me back. So if your company does really badly and you go bankrupt, then you may not be able to pay me back fully, right? And so that's kind of the debt relationship. Now, when I'm investing in equity, there is no paying me back. Instead, I own a piece of your company. And the value of that investment depends on how well your company does. So if your company does really well, then I get a share of your profits, right? So I'll make a lot of money if your company does really well. If your company doesn't do well, then I'm going to make less than I thought on your company, right? So equity is much more sensitive to how the company does than debt. Even debt is sensitive if the company does so badly it goes bankrupt. But equity will do badly even if the company does badly but doesn't go bankrupt. So that's the difference in risk you're taking between these two investments, right? In one, you're becoming a co-owner, in one, you're just lending money. So that kind of concludes the session for today. So what did we really learn? We learned that you have to think about your investment strategy relative to what you need your savings to do for you. If you need your savings to primarily be there for you for a rainy day fund and generate income for you, then you need to find investments that are going to match that. If you need a rainy day fund and you really want to grow your wealth aggressively, then you need a different investment strategy. So what we're going to do next time is I'm going to walk you through a sample portfolio that we construct for a hypothetical member that goes through this framework and builds a hypothetical basket of investments that are well suited for that person. So that's kind of what we'll do next time. It'll be an interesting class. And with that, I'll open it up for Q&A from this class.
Okay, so the first question is, many advisors talk about goal-based investing. What's your view on goal-based investing?
So goal-based investing, again, it's a bit of a vaguish term, but in my view depends on how it's being used. So sometimes advisors talk about near-term goals. They'll say, hey, you really want to buy a house, right? So that's your goal. And I'm going to help you buy that house. Now, I'm not personally a fan of that style of goal-based investing, because why do you want to buy a house, right? That's a question that needs to be answered by the person also, because the real goal of financial planning should be around living a life of security, safety, and prosperity, right? And if that to me is the end goal, and that's really the framework that I like working to, not near-term goals of, hey, I want to buy a Mercedes, or I want to own my own house, or I want to do all these things. These are all goals, but they're near-term goals. I think in my view, I'm more a fan of what are my long-term goals? When do I want to retire? What kind of lifestyle do I want to lead? How much income do I need to replace that lifestyle? And then how do we design an investing strategy for you based on that? Is, I think, a much more mature way of doing goal-based investing. So if some advisors do it that way, I'm a fan of that. I'm not so much a fan of, for example, there's a company called Easy Plan that helps people meet near-term goals. I want to buy a TV that costs this much. How much do I need to save? That I'm not a fan of personally.
What is the ideal percentage of these buckets?
So the ideal percentage of these buckets will vary based on your personal goals, right? So if you want to live a very lavish lifestyle and retire with a very lavish lifestyle, you have you enjoy nice things and all that kind of stuff, then you need to have a more aggressive investing strategy to be able to meet that lifestyle, right? And you're going to have to take more risk. And so that means your growth bucket will need to be higher. If you're a simple person, simple needs, you don't need to take so much risk. You can sleep more soundly and peacefully at night, etc. So the buckets really need to be thought of individually. The only thing that we really recommend is our advice on sizing that rainy day bucket. That rainy day bucket, we absolutely recommend that 6 months of your expenses are covered in your rainy day fund. That will ensure that if you run into problems in your life that cause issues in your income or expenses jumping up way higher than you anticipated, that you're going to have enough cushion to see you through without touching your other investments. That is something that we really recommend you size correctly. Then in terms of how big your income bucket is versus your growth bucket really depends on your aspirations in life. If you're a simple person, your income generating bucket can be 100%, right? Of your remainder of savings. If you are not so simple and want a more extravagant lifestyle, then you'll need to devote more of your assets towards the growth bucket. And how much is really going to depend on the actual maths of how much you have to save, how much you need to retire, and what kind of income you need to harvest from your investments at retirement. So we can walk through at a later class how to do that retirement math. We can build a model for members and put it on our website, which will help them calculate some of these things. But that's kind of the framework to go through for that. So more to come on that later. But a good question.
Okay, so the next question is more related to that, the presentation where you have year 1, year 2 to year 5, that
Yeah.
slide. It says when last year, which is the 5th year, returns are negative, so cumulative minus 20 plus. I'm not sure exactly what the question is here.
So let me just open the chat and read it. But I think the question is pointing out that in that example, equity actually had a negative return. Returns are negative. Yeah, so yes. And I'm just seeing, okay, there's another question. The person followed up. So Pankaj followed up and said, so equity long-term meager 1% above 1 lakh. So Pankaj, you're right. In the scenario that we looked at, right, equity did not end up being a very good investment over that time frame. The Rahul in our example actually lost money on his equity investments over that 5-year period. But why is that, right? Because equity markets go up and down. And we had one of the sharpest downturns we've seen in a very long time uh, in the COVID scenario. And um, whenever you put money in the stock market, you have to be prepared to keep that money in for, in our view, a decade, 10 years. And that way, with a 10-year period, it's very unlikely, given past data, that you will lose money on equities. You'll tend to perform pretty well in equities over a longer time frame. So in this 5-year period, yes, you're right. It just so happens that Rahul had the bad luck of investing uh, in a bull market and then selling in his investments in a bear market, which is kind of what you want to try to avoid. But over the long run, equity proves to be a pretty attractive investment for longer term money.
So Pankaj also said interest rate uncertainty as it keeps changing more so downward.
Yes. So, Pankaj, correct, right? Recently, we've seen a big tendency towards lower interest rates year after year. The important thing to recognize about today's environment is that there is a risk with all this money that's being printed globally and some of the changes that are happening to the supply chains globally, that we start to see inflation not this year, not next year, not the year after that, even maybe. But once we recover from the economic hit that we've seen in COVID, because so much money has been created around the world and because of these supply shocks, there is a likelihood that we may see inflation and significant inflation on the other end of this. So while you're right, over the last few years, interest rates have done nothing but move down. Uh, you, it's very dangerous to just rely on the past as your guide to the future. So even today, we recommend for our members, be very careful of interest rate risk. And when you look at very long term bonds that you're buying, buying a 10-year government of India bond and all these things, you want to be very careful about that because you're signing up for an interest rate for 10 years. Who knows what the interest rates are going to look like 5 years from now.
Okay. Since it is tax-free, this was referring to your PPF example.
Yeah.
We need to factor this in when deciding returns. And then what about liquidity investments in MF portfolios? Liquidity of investments in MF portfolios.
Yeah. So, okay. So let's take this in two questions. Since it's tax free, we need to factor this in deciding the returns. Absolutely, Rajnath. That's definitely something that we need to factor in. So if we were comparing the PPF to the to a taxable investment, we need to look at them on an apples to apples basis. So very good point. So what about liquidity investments in MF portfolio? So liquidity is generally pretty good in mutual funds, but certain mutual funds can have less liquidity depending on what they hold underlying the funds, right? So why did Franklin Templeton run into issues? It was holding securities that were not very liquid in the COVID market. It was holding bonds of companies. And when the economy kind of fell apart, essentially, people were not willing to buy those bonds from any sellers. And so they were unable to sell any of their investments. And that's why that mutual fund became illiquid. Generally, if you're buying large cap stock mutual funds, you're investing in large cap stock mutual funds, it's very unlikely to see liquidity issues with those portfolios, although the prices of those stocks can move up and down. So you'll be able to sell them, but you may be selling them at prices lower than what you bought them for.
Okay. Can you talk of some of the common traps that beginners fall into?
Sanjay, did you want to talk about that or you want me to talk about that?
I'd prefer to talk and you can supplement.
Sure.
So should I talk?
Yeah.
Okay. Okay. So, yeah, so I'm just going to talk about this Franklin Templeton since we had, covered that. So very often there were people who asked us as to why we were recommending something like ICICI over Franklin Templeton. And because Franklin Templeton was giving a higher return. And we said, like in debt investments or your rainy day bucket, etc., you should not chase return. You should chase safety. And we always felt that looking at the portfolio, the underlying portfolio of Franklin versus ICICI, we felt that Franklin was taking more risk and therefore giving a higher return. But since this was for a rainy day bucket, you should not be chasing return and you should be chasing safety. So this is a very common trap that beginners fall into because they say, both are identical, right? Like both are short term, ultra short term, the name is similar. So if this is giving me a higher return, then I should go with the higher return. Why should I go with the lower return? And they forget that the higher return may come at a higher risk. So one of the things that people should look to avoid, or at least they should try and understand, is that if someone is offering you a higher return on a investment, how are they doing it? So that is a question you have to ask yourself. And the second thing which I recommend is that don't chase return in your rainy day bucket. You can always chase return in your growth bucket. So I think Pankaj had asked this question about the equity returns being quite bad in this example. And Sahil had said that, these were based on the Nifty kind of numbers there. But what you have to see is that the Nifty was an index. Now, if you go into individual stocks, the returns can vary a lot. So even though the index didn't do all that great in these 5 years, but if you had gone into good stocks or good actively managed things, like at least currently, our small case is giving quite encouraging returns compared to the index, right? And there are other funds who have much longer track records, who have been doing that. So just to conclude, what I want to say is that be aware of traps when you're looking at what kind of returns that you're getting. And if you want to chase returns, chase them in your growth bucket.
Yeah, I think that's a very strong point. That generally the principle that we operate with in our investments and the advice we give to our members, if something looks too good to be true, there's probably a reason, and you need to understand what that reason is, right? Whenever you're making investments, and so um, there's no free lunch again in the investment world, and or there are opportunities where you can find uh, you know things that are priced favorably, right, in investing, but they're very, very hard to find, and as beginners we don't recommend trying to do that. And even experts, they spend all day trying to do this and they still make mistakes, right? So the important thing as beginners is asking yourself questions like, hey, why is this earning me a higher return than any other debt fund? I want to think about why, and if I don't like the answer that I think is what they're doing, then avoid the investment, right? It's better to be safe than sorry in investing, and understanding is your weapon in making sure that you're taking the appropriate safeguards. So we're going to talk more about this over this course, and you'll start to see how this all gets put together. It's a lot to absorb, but at the end of the day, we're going to cover some practical tips for everyone where we make it as simple as possible to do. The good news is that there are a lot of tools that we can use that ensure that we get really reasonable returns and limit the risk of downside tremendously, right? And we're going to start discussing these in the next class. So great. Thanks everyone for joining, and we'll see you in 2 weeks to continue on our sessions. Bye.